Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to be using. Well, the markets continue to set new all time highs, but are all sectors of the economy joining in this party? We'll talk about that. We'll also talk about bonds in your portfolio, and it's also time to start thinking about taxes. It is coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Kerry Coghill of Coghill Investment Strategies. Next, we find Frank Rossetti. Frank has his own alternative investment company, HF Management Company. Also sitting at the table with the adults is Kim Forrest of Boca Capital Partners. And there's one more seat at the table, and that goes to Michael Godwin of the Fergasso Financial Advisors. He's the chief investment officer there. You know, it seems like we stood and talked like this before. Now, that's a lyric from a song, Where or When, written in 1937 by Richard Rodgers and Lawrence Hart. 88 years later, there is another lyric from the song that can be applied to the stock market today. Some things that happen for the first time seem to be happening again. All right, I know, it's a stretch of some sorts, but we have talked about this before, and it seems to be happening again, and that is the markets just seem to keep climbing higher and setting all new all-time highs again last week. So, for the year, all of the major indices are on a percentage basis are up double digits. So with that kind of advance involving the major indices, are all the stocks enjoying such a robust year, or are there sectors which are lagging behind? Kim, I'll throw that first question out to you.
Well, I think there's some sectors that are lagging behind. Oddly enough, financials just don't seem to be keeping up. But I'm not somebody that really loves talking about sectors because I look at a more granular kind of stock market, which is individual securities. And yes, they belong in sectors, and you can kind of sift your way through to find some bargains, we'll say. But I think it's more important to find companies that are outperforming their peers and to really dig in deep and see what that company's made of. The future is uncertain. I don't know if that's the title to a song, but even good companies, stumble. Even good economies stumble. And I think knowing that your companies that are well positioned to outperform their peers, that's kind of the tack we take. So I'd like to know what other people around the table. And by the way, kids' table is way more fun, but this one's pretty fun too.
I don't doubt that.
So our approach is a little bit different in that when we're looking at what stocks to add to a portfolio, we actually are starting with sectors. So, you have the S&P 500, right? And that's everyone's benchmark. And if our job as advisors is to, outperform in one way, either performance-wise or based on risk, then we create and have insight as to, what we think the sectors that will outperform or underperform, where we see the future going in that way. And so then with a portfolio, we can make decisions about what sectors to overweight and what sectors to underweight. So Stacy, to your point, we have seen some sectors really underperform this year. Financials, as Kim said, healthcare, materials, and we've seen other sectors outperform. You can all guess what sectors those are. Information technology, communication services, all of those kind of AI-related companies. So, when we look at economic data and we look to the future, that's really how we're looking at sectors. One of the sectors that has been very interesting to watch this year is actually consumer discretionary, because consumer discretionary has not done well relative to the rest of the market. But as I mentioned a couple weeks ago, I was at Ross Park Mall and couldn't find a parking spot. So I think that what we're finding with that sector is maybe some pricing pressure with tariffs, so that even though consumers are spending money, companies may be having to eat some costs, so that earnings haven't been quite where we would want to see them. And just the fear of tariffs and how tariffs will affect consumer goods.
It's
Michael,
funny.
you're the Chief Investment Officer for Gasso, so give us your take.
Yeah, Carrie brought up that you can guess what sectors are doing well this year, right? The information technology, communications, but that wasn't always the case this year. I mean, if you look back to what happened in February, March, and April with when the tariff uncertainty was hitting, and then Liberation Day, those were the laggards of the market. The Magnificent Seven really was what was driving down the market at that time. And then when you got a little bit of clarity on what the tariff situation was going to look like, even though there were tariffs, we saw a little bit of a rebound there. So I think the technology sector and communication services sector, as Kim would probably point out, that's going to continue to be the growth driver of the economy, of the markets. The big problem is Kim and I might disagree on this a little bit. They are really are priced like there's nothing going to kind of go wrong. If you do have a blip somewhere, if Nvidia starts to say, you know what, we're starting to see less demand, that's probably going to drag the markets down quite considerably at that juncture. Is it a buying opportunity when that happens? Maybe, but those stocks are they've been the driver of the markets for the past decade. They could continue to be going forward, but they are priced like that right now. So that would be something I'd be concerned about going forward. If you do start to see any sort of slowdown in AI or any sort of demand decline in that realm.
That being said, on a long-term basis, which most of us are long-term investors, um, those blips that may happen that Mike discussed are probably going to happen somewhere. Something will happen to create a bump in the road for these things. However, the economy is being driven by this stuff, has been driven by this stuff since the Texas Instrument came out with the first, what were those chips called? Silicon chips, okay? And that being said, uh, yeah, it's going to go up and down, but if you have a long-term time horizon, I would just use that to accumulate more, a dip. And as Kim constantly says, technology is what's driving the economy, and it looks to me as though it is the only growth driver worldwide that exists because we have a shrinking workforce and we have to replace it with technology, whether it be robots or computers or things that people haven't thought of yet, which I'm sure that actually somebody thought of it, they're trying to make it work. We'll know what it is when they make it work, I guess.
Michael, I'm going to go back to you on this one. You mentioned NVIDIA. I believe there was a story in, I think, the Wall Street Journal. I'm not quite sure where I saw it about two other companies perhaps getting together. I don't know if it's a merger or not, which basically would take on NVIDIA. When you see a story like that, that there could be greater competition coming, how should an investor react?
Yeah, that could be a good question for Kim since she's the smartest in the room.
Okay.
I think I saw something about OpenAI partnering with AMD. You're
Yeah.
gonna have some of those there for sure. The problem is the infrastructure that goes into these chip companies is just massive. And once you get the sort of first mover lead, kind of like OpenAI has. Everybody's playing catch up to OpenAI, and I know Elon Musk. There's an article in the journal today about XAI trying to really build out its data center facilities. They're doing that in Memphis right now. It's going to be very hard to catch up. So I think it's great that there's more competition there. That could help drive down costs a little bit. But Nvidia's so far ahead of the game right now with what they have that it's going to be hard to fully play catch up.
What does the smartest person in the room say?
Well, I don't know. You'd have to ask whoever is going to say the right answer, but I'm going to put mine out there. I don't think I'm the smartest in the room. But so my big fear is this. Everybody is looking at generative AI because it's kind of fun to use, and it's really kind of fun whenever a computer talks back to you and in a language that you both can understand, which is English, as opposed to, I went to school for computer science where I learned languages to make computers do things. Think about that. Anyhow, my biggest fear is that a lot of this is the fun stuff that people are attracted to, which may not be the productive stuff, like the walking robots. So there's so much compute power that just goes into making these things be able to pick up, like the things that look like a human, right? The robots that look humanoid. Too much processing power is just making it stand up and not fall over, okay? What I think is going to be interesting is when we have task-enabled robots. No, that's not Rosie the robot that's going to make your bed and scramble your eggs perfectly and do all that human stuff, but more in the line of robotics for maybe fast food cooking, where it's the same task over and over and over again, right? So those are the kind of things that I think we should be watching for. A lot of this stuff that would be featured on a movie 10 years ago as being unthinkable and cool technology is probably going to suck up a lot of money and never see returns because it's not productive. And that's my big warning. Whenever you are going to make a tech investment, make sure productivity is driving it, not how cool it is.
Yeah.
Good.
And
Am I a bubble buster or what?
And the other thing I wanted to point out, back to Michael's point about, this year, and you look at tech and AI and how it really struggled at the beginning of the year. One of the influences that kind of changed the trajectory of that has to do with our favorite topic, interest rates, right? So we have seen, interest rates come down. Once that dialogue happened earlier this year, we started to see the sector switch course. And, I just also want to reiterate that these tech investments, and especially if we were to have some sort of a sell-off and, does that create a buying opportunity, you really have to look at your time frame. I do think that, as we know, there's not a lot that we can say about short-term performance, but good solid companies over the long term, as long as productivity, cash flows, et cetera, all line up, they're going to ebb and flow. And I think that for long-term investors, when you have sell-offs, one of the mistakes people make is that they try to find the bottom instead of just saying, you know what, it's discounted enough. I'm a long-term investor. I know over time that this should play out well.
Yep, you may have just answered the question I was going to ask, going back to what Kim said earlier on, and that she likes to find companies that are outperforming their peers at this time. So go ahead and take a look at those companies that are really doing well, and as opposed to trying to find one that could be on the move up.
Well, I think, I don't know if, I'll just answer this and then whoever wants to answer it. Okay. Anyhow, so it's a two-faced question. What you might really want to do if you're bargain hunting is find a company that kind of sort of missed the mark and then has really got its mojo back. Or you can take comfort in buying somebody that has proven over more than one product cycle that it knows what it's doing. And what I mean by that is product marketing. It understands its consumer. It understands what the consumer wants, and it can provide it over and over and over again. So I could talk about individual names here, but you can find both of those. Ones that have stumbled and yet can come back because they have the structure there, and ones that are just killing it and have been and maybe always will.
All right, great. Let's move on if we can. The latest revisions to the employment numbers are adding to the belief that the Fed indeed will lower interest rates again in this month. As bond yields begin to come down, an article in the Wall Street Journal indicated that corporate bonds are on a tear. So anyone want to take on this one and explain why that would be happening?
Well, one thing you need. Go ahead, Frank.
There's some people who think that corporate bonds, high quality corporate bonds, are a safer bet than the U.S. government. And on paper, that might be true. In reality, corporations do not have a printing press, and the United States government does. So from an accountant's perspective, those people are right. But from a practical reality point of view, the guy that has the printing press will pay off his debt. Might be with worthless paper, but it'll be paid off nonetheless.
Yeah. When you're looking at bonds as an investment in general, um, an interest rate environment that is declining is very additive to bonds. So, you not only if you can lock in at, current rates, and then we see interest rates come down, not only are you picking up your yield, your income on your bond, but those bonds become more valuable because newly issued bonds are happening or paying lower returns. So you actually pick up some capital gain potential when you're in an interest rate environment that where interest rates are going down.
So
Interestingly, and those, as I look at this, the Treasury yield since the middle of September, which is about when the interest rate cut happened, right, actually has gone up very little, but gone up the 10-year, which I find it curious. And but we talked about this a couple of weeks ago, maybe 4 weeks ago, I don't remember. Um, but there's a interest rates on longer bonds, not the overnight rates that the Fed controls, but the longer bonds that the market controls might be being driven a little bit by, or affected negatively possibly by the concern over rising inflation possibilities. None of that has played out in a definitive way yet, but it's a risk. And you need to measure risk before you make investments. And that risk versus the reward that's available has to be in line. Risk reward is a big deal. Don't ever forget it. And with bonds, high returns, you're not going to get 20% in a bond these days.
So the other angle to this is that when you look at what Frank was talking about, where longer dated yields are actually staying up, staying higher, it could be inflation, but it could also be the fact that the economy is not doing as bad as people think. And when you have interest rates that are going down, which is designed to stimulate the economy, what those longer dated bonds may also be telling us is, you know what, that's going to do its job, and we have an economy that is actually functioning quite well. So that's why we're not seeing those longer dated bonds come down. Now, could be inflation, could be the fact that maybe the economy's doing better,
Or both.
or both.
yeah, and you're going to get to a point where I think you're at a point now where yields are so much better than they were in 2021, 2022. And so you're finally getting paid in fixed income. And to Carrie's point, I think both Frank and Carrie are right. I think you're going to have inflation that's going to remain more elevated than the Fed really wants, but also growth looks pretty strong. I don't think I think recessionary forecasts for 2026 are pretty light. High yield bond default rates for the second straight year are below 2%, which is very, very good. So investors are paying up more to get extra yield, even if those spreads kind of compress compared to what the U.S. Treasury bonds are yielding now. So there's not a lot of investors in the fixed income market are pricing on. There's not a lot of risk out there for default rates, which is why corporate bonds and the broad bond market in general have done very, very well so far year to date. Now again, just kind of like the tech side of things and maybe even the broad based equity markets, things are priced not to perfection, but things are priced like nothing's really going to go wrong in the markets here. So again, a lot of that's been playing out over the past year, and it looks like that can continue. You can continue to clip that coupon rate in the corporate bond market, which is still very, very good. I mean, you're finally getting paid now to own some bonds. But again, as long as the economy continues to hum, which I think it probably will, that's good news for investors.
One of these days, I'd also like to get a little bit more into bonds and municipal bonds and who should buy them and that sort of thing. We'll put that off for another segment if we can. So now we are into October. We made it through September. September and October, of course, are the two I think, most of the time, most volatile months of the year for the stock markets. So since we're in October and we've gotten 9 months out of our way, Is now the time to start taking a look at taxes? And if so, what should an investor be taking a look at right away? Carrie, I'm going to start with you on this one.
Yeah, well, we like to look at tax loss harvesting every day of the year, and thankfully we did earlier in the year when the markets were down. When we head into the end of the year, that's generally when people are looking for their losses, and there might not be a lot right now because the markets have gone up so much. So going into the end of the year, a couple of things that we want to do is also really focus on the charitable giving, looking at our clients' tax situation, trying to make some determinations about gifting, but also, we use other vehicles such as donor advised funds where you can create an account that's a donor advised fund, super easy to do. You can still manage it, but the money that you put into that donor advised fund today, you get to deduct from your taxes today. So if we have a client that has had an unusually high income year, or for other reasons they're paying more taxes this year, and they're also charitably inclined, we may front load that donor advised fund so they have the benefit of getting the tax deduction this year, even though maybe they don't want to give all that money away to charity, today, that, over the next X number of years. I'm working with a client right now that had a liquidity event. So we're trying to plan out, what do you see your charitable gifts to be over the next 10 years? Let's front load it into your donor advised fund today. You benefit from the tax deduction. And then when you're ready to start giving it out to charity, we can do that. So those are some things that we're looking at kind of above and beyond just what tax losses there might be to take.
Anybody else? Everybody
That
loves
was
tax.
All the
pretty.
bases.
Yeah, that was pretty informative. I think the one thing that I'd point out is, if you own mutual funds and ETFs in your portfolio, I mean, if you're still owning mutual funds, you got to be paying attention to capital gains distributions that come out, in the next couple of months. See if it makes sense to sell out of that position and go into something else to avoid the capital gains distribution there. If you own ETFs and mutual funds for a while, the likelihood of being able to sell out of that at a loss is difficult. The nice thing about, I guess, the way Carrie, Kim, and I manage portfolios for our clients is we kind of have, at least Carrie and I probably have a mixture of both, ETFs and individual equities. So if you own the S&P 500 this year, obviously it's done well. It's up 14%. But if you were somebody that used a direct indexing strategy or something of the like, you very, very likely had a number of underlying holdings that were trading at a loss throughout the year, and even into October, which you can continually take advantage of selling at a loss and offsetting that with another like-minded security. That way you can accumulate losses over the years. I mean, again, very nuanced strategy, but very, very beneficial for clients who are tax sensitive and want to avoid paying taxes. I mean, that's something that, we do frequently. I know Carrie does as well, but that's really the benefit, I think, of, having a financial advisor or somebody like us, manage money for clients.
On the flip side of that, um, as the year progresses and we get closer to the New Year's Eve, this tax loss selling will cause companies that have not done well to go down more than they probably should. And if those companies are diamonds in the rough, if you will, those companies may be that tax loss selling may create a buying opportunity in those good companies who happen to have stubbed their toe or for whatever. Look at the reason why the company hasn't done well, of course, to make sure it's a passing thing and not a systemic issue. That being said, there's plenty of ways to figure that part out and do it before it's purchased. But this selling might create some opportunity. I know that in the few accounts that I'm still involved with, we're having a hard time finding losses. But
Yeah.
and in the mutual fund, if you bought a mutual fund in September, you're going to get a distribution probably in December. for the entire year's capital gain. And it will probably exceed the profits you have in that fund, in the mutual fund, not the ETF, the mutual fund. And this could be a problem for you from a tax perspective. However, people get very upset about that, and it is upsetting when you have to write the check, but your cost basis will go up by the amount of that capital gain. So in the future, your profit will be less as a salve on the wound.
Yeah, yeah, it is very tricky right now. Um, if you're investing in actively managed mutual funds in non-taxable or in taxable accounts, uh, because we don't know at this point what those gains distributions are. And to Frank's point, if you bought a fund this year, it's possible that you're going to pay tax on money you didn't earn. You do recapture that at some point, but we're always looking at all the funds that we used, and as they report what their distributions will be, we can go back then and do some swapping to help clients avoid unnecessary tax.
And at the end of the day, if you have to pay tax and you've made money, sorry, but you're making money. So let's keep everything in the correct view.
All right, now,
Can I tell a fun story about that?
sure, go ahead.
30, 40 years ago, I was sitting with my
I
father.
knew I was going to be 30 or 40 years ago.
Well, you can't forget that I bought my first stock in 1961.
All right,
And that being said,
and you still own
my
it.
father, the CPA, and I had a common client. We were having lunch in April. And my father said to me, you cost John $50,000 this year, which back in the mid 70s was a lot of money. And I said, how's that? And he said, he had to write a big check because of you. So I said to John, just to agitate my dad, of course, like any good son would do, John, I'll tell you what, you give me the profits and I'll pay the tax.
Yeah,
My father never said that to me again.
no, probably not. Probably not. Not to get too much into the weeds for what you guys do, but if you do sell, let's say you've purchased a stock several times throughout the year or years ago, and somebody mentioned cost basis before. Does it make a difference? Can you delineate which time you bought the stock is the one you're selling? Because that
At
would
the
make a
point of
difference,
sale, yes.
right?
Yes.
Yes.
But you have to do it as you enter the order to sell.
Yeah, you have to be smart and set it up that way. However you set it up when you initiate your account with whatever custodian you're at, or then you can get very nuanced and pick the lots you want to do as well. So you got to be very mindful of that.
Right. And the magic word probably at every custodian is tax lot. That's what you're trying to, average cost basis is not what you want. You want it by tax lot. A lot of the times in where I've done tax loss selling, I wanted only to sell the shares with, the lowest cost, the highest cost basis, so I could capture, the difference. I'm thinking on the fly, but I didn't want to sell at an average price. I wanted to get rid of the things that would give me the greatest realized loss. So that would be the smallest capital, anyhow, you get it. We're trying to generate losses here, so do the math, but tax lots is what you want to have your account set up as.
I mean, that just sounds, antithetical here. That you want to generate losses, but I do understand what you're saying. I think.
Yes, but that's the whole point here. Like, you want to, if this is a game, you want to make as few moves as you have to, but you want to make them pay off as big as you can. That's the game.
Okay.
I will add one caveat to this.
Yep.
Is that when we're looking at how much tax our clients pay, one of the things that can become a problem is that if you're always trying to not take gains, you can really back yourself into a
Yep.
corner
Yep.
to the point where you own something and you've never harvested any gains along the way, and now it comes time that this investment isn't quality anymore, and now you have to sell it and you get hit with a huge gain. So there's something to be said for, regularly tax loss harvesting, because it enables you to have more flexibility over the long term. I can't tell you how many people are like, I don't want to sell it because I'm going to pay a gain. And our answer is, well, that problem's never going to get better. It's only going to get worse. And you run the risk of losing money when we have overweight positions. So sometimes we have to run the calculation, here's what your gain would be. But if this stock goes down by 20%, here's how much money you're going to lose. So creating that perspective is really important, because I will tell you, clients hate paying taxes. So I'm always kind of battling with our advisors, because I may say now's a good time to take some gains, and they're like, no, the client doesn't want to pay taxes. So we kind of have to hash it out and let the client decide. Like, here's the case for both. How comfortable are you with this?
And to pile on to what Carrie's saying, this is a portfolio management problem, right? You can, over time, if you just let your garden grow without any weeding, let's put it that way, you are going to end up with one big patch of something that was doing well. And guess what? It's not going to do well. So that will kill your overall portfolio returns.
Yeah.
If you didn't harvest those, wow, it all works with gardening, doesn't it? If you didn't harvest those gains over time. So our job is to make the whole portfolio grow, not to necessarily go, well, that's my favorite stock, or I don't want to pay taxes on that, or blah, blah, blah. We are trying our best as professionals to make your money, your account, not individual holdings necessarily, but your account be bigger next year than it is this year. And we really do know what we're talking about when we say, oops, you're going to have to pay some gains. Because I see a lot of really ugly portfolios come in. And you're like, wow, somebody really let this thing go. It is a mess.
It's funny, Kim. I just thought of another great gardening analogy, because
Oh,
we talk about diversification and how things perform at different times. It's like a garden, right? You want things blooming in the spring, in the summer, in the fall. There you go.
Right.
great.
Good. Well, we've run out of our time. In fact, we're a little over that, but that's okay. This has been an interesting conversation, and we'll continue to look at investing in the economy in future editions. Again, I ask that if you're watching or listening to this podcast, that you hit the like or the subscribe button on whatever platform you happen to be using. Right now, thanks again for joining us. We'll see you again in about 2 weeks for a next edition of The Bull, the Bear, and You.